What is going on, guys, and welcome back to another very exciting video. In this video, we're going to be talking about a stock that I do not talk about a whole lot on the channel, and that is Apple. And I do personally own Apple, but there's never really a lot of interesting news going on with the company. But here in the last week or so, Apple announced that they are starting their own savings accounts. So what we're going to do in this video is we are going to go over what those savings accounts look like. We're going to go over who Apple partnered with to make this a possibility. And then we're going to talk about what Apple could potentially do in the future to bring this even more in-house and profit more from this change. So if you enjoyed the video, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. Let's start off by taking a look at Apple as a stock. We can see that their PE ratio right now is sitting around a 28 compared to the market, which is trading around a 20 to 23. They're trading at a little bit of a premium. That's kind of to be expected with Apple, as they are one of the great companies in the market right now. We can see that their market cap is sitting at $2.61 trillion, which is incredible. And then if we look at their dividend yield, they're sitting at a 0.56. So this is really kind of terrible, but they have plenty of room to grow this over the next 3 to 5 years. They have plenty of cash flow, plenty of earnings to continue to grow their dividend. If we look at today, they're down around 1% over the last 5 days, basically traded sideways. Over the last month, up 4.5%. Over the last 6 months, up around 10.5%. And if we look at the last year, they've experienced a lot of volatility along with the rest of the market. And if we look at their high here in August of 2022 to their low here in January of 2023, we can see that the stock moved down almost 30%. So what we are going to discuss in this video is that Apple has launched its savings account with a 4.15% interest rate. The account requires no minimum deposit or balance, has no fees, and also users can set up the account from their wallet app on their iPhones. And when it comes to high yield savings accounts, Apple is actually fairly competitive. We can see that PNC currently offers an account at 4.3%, Marcus by Goldman Sachs at 3.9%, Lending Club at 4.25%, and then we have Synchrony at 4.15%. So overall, Apple is actually very competitive. They're staying within reach of a lot of these smaller banks. Oftentimes what smaller banks will do, like PNC or Lending Club, they will look to offer high yield savings accounts to get customers in the door and really maintain those customers. Apple is taking a very similar approach. They're trying to get customers to use their high yield savings accounts by offering a higher yield than a lot of their competitors. However, the advantage that Apple has is that they already have the Apple Card and Apple Pay, and they offer 3% cash back on these brands down here. They also offer 2% cash back with Apple Pay, and then 1% cash back on all other purchases. And what that does is they are set up to automatically deposit those cash back returns into these savings accounts. So this really incentivizes people to grow their network within Apple and really sync their Apple Card with this savings account and potentially earn that 4.15% on their cash back. And this is something that Apple and a lot of other great companies do really well, is integrating new products into their existing ecosystem. However, it's important to keep in mind that Apple is not providing these services on their own. They have actually partnered with Goldman Sachs to provide all of their financial services, whether it's their credit cards or their savings accounts. And Goldman Sachs actually offers their own high yield savings account. We can see that that is Marcus by Goldman Sachs, and it is currently at a 3.90 APY. And obviously when we compare that to Apple's 4.15 APY, we could see that Apple is probably supplementing their annual percentage yield to increase it above Marcus by Goldman Sachs and get it into a more competitive range to actually entice customers to sign up for the account. The big winner from all of this may actually be Goldman Sachs, because Goldman Sachs has to be getting paid by Apple to actually offer the credit cards and the savings accounts. And that is actually a benefit because they have already built out this ecosystem of checkings accounts, savings accounts, and credit cards. And really all they have to do is build that into Apple's ecosystem and let the customers flow in. And I would have to guess that they're getting just a fee basically from Apple for offering these, and that overall is going to help Goldman Sachs in the long run to potentially even get more customers brought into their own ecosystem. And we can see that Goldman Sachs right now, they're trading at a 12.17 PE ratio. This is fairly average for banks. When they start to get to around a 15 plus, that's when banks are trading more at a premium. And when we look at their dividend yield, we can actually see that they have a fairly good dividend yield at a 2.93%. And Goldman Sachs has actually suffered recently from the banking crisis, so they went down around 19% as a lot of these banks fell over the last few months, and since they have recovered actually 12.5%. One thing that is interesting is if Apple continues to expand their banking side of their business, they could potentially look to acquire a banking company. Obviously, working with Goldman Sachs right now on these smaller projects, it makes sense. They can really integrate these products, see if there is a use case and a customer base for them to actually keep these as part of their ecosystem. But if over time they continue to grow these areas and they continue to expand them, they probably won't want to pay Goldman Sachs to continue to support them. They'll want to bring them in-house. And what they could do, instead of trying to build out the systems on their own, they could basically acquire a smaller banking technology type company like a SoFi or like an Ally Bank and really integrate the existing software of these smaller companies into their Apple Pay system. Do I think that is something that would happen overnight? No, I think there's a lot that Apple still needs to build out and really prove that this fintech kind of industry is something that they want to get into before they really dive in with an acquisition. But I do think over time, if they continue to expand these businesses, it makes more and more sense for them to acquire a business instead of paying someone else to support this infrastructure. So with all that said, make sure you do your own research on any of the companies that I've talked about here today. I personally do own Apple and I do own SoFi. I do not own any Goldman Sachs, but I do think Goldman Sachs is a very interesting bank. I think they offer a lot of good services and have a very, interesting business model. So with all that said, again, make sure you do your own research. Do not buy a company just because some random guy on YouTube talked about it. But I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And as always, guys, have a wonderful rest of your day.